You can be free, and you can live anywhere in the world, and independent from routine and not have to answer to anybody. Alexander Elder. Welcome back to Book Club. We are going to continue where we left off the last time, which was Chapter 5, Managing the Trade. And we were specifically on controlling losses. Okay, controlling losses. Your level of risk seeking or risk aversion is personal. Therefore, nobody can design rules for you. You must do it for yourself. Ask yourself whether you'd faithfully follow every buy-sell signal of a given indicator when history suggests you'll have some trades that entail a loss of 50%. No? Well, how much of your trading capital are you prepared to lose? This isn't an idle question. Your answer is critical to whether you succeed in technical trading. If you say you can accept no losses at all, forget technical trading. You will take losses in all trading, even well-designed planned technical trading. If you say that you're willing to lose 50% in a single trade, whoa, Nelly! Exclamation mark. That's too much. 3 or 4 losing trades in a row and you wouldn't have enough capital left to do any trades. I offer some help in deducing your personal number in the following sections. Experienced traders ask themselves, how much will I lose today? When they wake up every morning, they expect loss on some level. In contrast, beginners find losses almost impossible to contemplate. Yet if you don't control losses, the question is not whether you go broke, but when you go broke, as a famous trader named W.D. Gann, I think I am pronouncing that correctly, wrote on the very first page of one of his books. Exiting a losing trade is heartbreaking. For one thing, it means your indicator let you down. Accept that your indicators have shortcomings and that your job is to overcome those shortcomings by using money management rules. A bigger problem may be your bruised ego. To sell a losing position means that you failed, and the standard response to a loss is denial. It will come back, you cry. In the long run, maybe it will come back, but by then, you may be broke and unable to take advantage of it. As I show in Chapter 1, the percentage gain that you need to recover a loss can be shocking. To recover a 50% loss, you need to make a 100% gain. Every top trader admits to taking bigger losses than they planned. Many go out of business for a period of time only to come back later with essentially the same indicators and better ways to manage the trade. In fact, some investors say that the best time to place money with a professional trader is right after she has taken a fat loss, because then he's a better trader. Note that such investors aren't predicting that he'll be a better indicator analyst, but a better trader. You can find good lessons on this subject in the Jack Schwager books. Often the secret ingredient to the wizards, or the secret ingredient the wizards discovered to gain lasting success, is the mindset and discipline to control losses. Using the first line of defense, stop loss orders. You may use a stop loss order to overcome the unreliability of indicators as well as your own emotional response to losses. A stop loss order is an order you give your broker to exit a trade if it goes against you by some amount. For a buyer, the stop loss order is a sell order below the current market price. For a short seller, it's a buy order above the current market price. If market conditions are choppy, high volatility, you may want to widen your stop even though your own particular security is behaving nicely. In this instance, you fear an overflow effect from the general market to your particular security. You may switch from a money-based trailing stop like the 2% rule to a volatility or pattern type of stop. Here's an overview of the main types of stops and how they work. Don't skip over this section. More than likely, it can save your bacon from a catastrophic loss. Mental stops are hogwash. You should enter your stop loss order at the same time you enter the position. In fact, you need to know the stop in order to calculate how big a position to take in the first place. If you're using any risk management rule, why some traders don't do this is a mystery. Many traders say they keep a mental stop in their heads, but this method is a delusion. It's a self-delusion to think that you'll be watching the price every minute the market is open, and you'll have the gumption to sell at a loss if the limit is reached. But no one can watch the market every minute, and in practice, most traders with mental stops sit hopelessly by as the trade goes further and further against them. Other traders say that their security isn't suitable for stops because it's too volatile, or the trader is so big that the market would find out where his stops are and maliciously target them. Yeah. Another rationalization is that the trader's stops get hit, and often only for the price to move back in the original direction right afterward. This excuse isn't a reason to avoid using stop losses. It is a reason to reset the stop to a better level. God damn, this book be preaching. Okay, to pretend that you have a mental stop or to refuse to place stops is to avoid accepting the reality of trading. It's a business, and setbacks happen in business. Setting a stop loss order is like buying insurance in case the house burns down. Not to take out insurance is to treat trading as a hobby and view the amount at stake as play money rather than as risk capital. Sorting out the types of stops. Technical traders have developed many stop loss principles. Each concept is either a fixed trading rule or a self-adjusting one. Stops relate to indicators, to money, or to time, or often these three don't line up neatly to give you an easy decision. You have to choose the type of stops that work best for you. The 2% stop rule. Probably the most famous stop loss rule is the fixed 2% rule that was employed by a trading group named the Turtles. To find out more about how to complete amateurs were taught to trade successfully on trading rule discipline alone, check out The Way of the Turtle, McGraw-Hill by Curtis Faith. My God. Okay. The 2% rule states that you should stop a loss when it reaches 2% of starting equity. If you're trading risk capital of $10,000, you can afford to lose no more than $200 on any single trade if you expect to stay in business for a long period of time. The 2% rule is an example of a money stop, which names the amount of money you're willing to lose in a single trade. $200 may sound like a tiny number to you, but in the context of active trading, this figure is quite large. You need only 50 losing trades in a row to go broke. And 50 trades may sound like a lot of trades, but you find that many valid indicators have you trading that often depending on your time frame. If you're trading 15-minute or 60-minute bars, you could easily have more than 100 trades in a month. If you're trading 5 securities, for example, you go broke after 10 consecutive losses per security. Risk-reward money stops. The risk-reward ratio puts the amount of expected gain in direct relationship to the amount of expected loss. The higher the risk-reward ratio, the more desirable the trade. Say, for example, that you're buying Blue Widget stock at $5 and your indicators tell you that the potential gain is $10, which means that the stock could go to $15. You could set your initial stop at $2.50 or 50% of your capital stake. For the chance to make $10, that gives you a risk-reward ratio of 10 to 2.5 or 4 to 1. Strangely, the amount of the gain, the reward, is always placed first in the ratio, even though it comes second in the name. But consider the premise for this example. Your ending capital triples your initial stake. But gee, expecting a 300% return is going a bit far, isn't it? Well, it depends on your skills. If you consistently forecast and get 300% gains, good for you. You may be able to accept a higher initial stop loss level than other mere mortals. To apply the risk-reward ratio in a conservative and prudent manner, turn it upside down. Instead of calculating it with your best case expected gain, use a realistic worst case estimate of the loss. Your worst case gain should be higher than your worst case loss. For example, say you're prepared to lose $2 for the chance to make $4. Your risk-reward ratio is 4 to 2 or 1 to 2. If you practice this exercise on every trade, the risk-reward ratio becomes a filter that winnows out trades that may be high probability but with excessive risk. Calculating the risk-reward ratio and using it to set a stop has its own dangers. In the earlier Blue Widget case, you're willing to lose 50% of your capital. If you lose, you can take only a few such trades before you run out of money. Moreover, you can start out with a fixed risk-reward money stop, but then change it to an adjustable stop as you modify your idea of how much the trade could potentially gain. I like that. That's my current style. Say the price falls from $5, your original entry, to $3.50, but the average range is widening and still telling you the potential high is $15. If you buy more at $3.50 and the $15 is indeed reached, your gain is even bigger in percentage terms. Using the risk-reward ratio this way is how traders trick themselves into adding to losing positions. the blackest of cardinal sins in trading. All right. Analyzing risk-reward ratios can quickly become a complex task requiring knowledge of statistics and probability, but you can take a stab at it using simple arithmetic as the examples in this chapter. Any estimation of risk-reward is better than none, and surprisingly, after it becomes second nature, your comfort level with trading will rise. The central idea is that in technical trading, the general rule is to take small losses and aim for bigger gains, not to take big losses and aim for gigantic gains. All right, maximum adverse excursion. John Sweeney developed the concept of maximum adverse excursion, which is the statistically determined worst case loss that may occur during the course of your trade. Using this method, you calculate the biggest change in the high-low range over a fixed period, let's say 30 days, that's equivalent to your usual holding period. Actually, you need to calculate the maximum range from the entry levels you would have used. Because you know your entry rules, you can backtest to find the maximum range that was prevalent at each entry. For example, if the security never changes from high to low by more than $10 over the period, you could set your stop at $11. You should see a regular pattern between the maximum adverse excursion and your winning and losing trades over time. In fact, you can use the inverse of the adverse excursion, the maximum favorable excursion, to select trades in the first place. See chapter 14 on volatility. Trailing stops. Trailing stops use a dynamic process that follows the price. You raise the stop as the trade makes profits. A trailing stop is set on a money basis. You maintain the loss you can tolerate at a constant dollar amount on percentage basis. You could, for example, say that you want to keep a 20% of each day's gain, so every day you'd raise the stop day to include 80% of the day's gain. This method means calling the broker or re-entering the stop electronically every day. The important point is to keep the stop updated to protect gains and guard against losses at the same time. Trailing losses are highly protective, but you risk being stopped out on a noisy price event that isn't really related to the overall price trend, like calendar events or the payrolls report for the first Friday of every month. The normal average daily trading range encompasses the trailing stop level on most occasions, but you can still get stopped out on a random event causing an abnormal off-trend spike. It's hard to imagine a trailing stop working with crypto. It's so volatile, I guess maybe with a certain amount of experience. Okay. Indicator-based stops. Indicator-based stops depend on the price action and the indicators you use to capture it. Indicator stops can be either fixed or self-adjusting. I mentioned them at various places throughout the book. Here are some important ones. Number 1, last three days rule. The most basic of stop loss rules is to exit the position if the price surpasses the lowest low or highest high, if you're going short, of the preceding 3 days. This idea sounds a little corny. However, it jives well with another piece of trading lore that says a trade should turn profitable right away if you've done the analysis right and you're actually buying right after a low or selling right after a peak. If the price first rises for a day or two but can't hold on to the gain, the up move that you think you've identified is probably a false one. Consider the crowd dynamics, see chapter 2, and how they play out on the price bar. You need a series of higher highs and higher lows to name an uptrend. If you get lower lows in the first 3 days, the probability is good that the trade is going south. Number 2, pattern stops. Pattern stops relate directly to market sentiment and are very handy. Most are of the fixed variety. I list a few here. The break of a support and resistance line is a powerful stop level chiefly because so many other traders are drawing the same lines. The last notable high or low, or the historic level, see chapter 4, or the high or low of an important time period like a year are noteworthy. You can infer stops from other pattern indicators such as center confirmation point of the W and a double bottom or M and a double top. When the confirmation point is surpassed, The probability is high that the move will continue in the expected direction. If you're positioned the wrong way when the pattern appears, the pattern confirmation is also your stop level. And number 3, moving average stop. You can also use a separate indicator that isn't part of your buy-sell repertoire to set a stop, such as a moving average. Many traders use a breakout beyond the 10-day moving average as a warning to reduce a position and the 20-day moving average as a stop. You may find it interesting how often a retracement will penetrate a 10-day moving average but halt just short of crossing the 20-day moving average. A moving average stop is clearly of the self-adjusting variety. Volatility stops are the most complex of the indicator-based self-adjusting stops to figure out and to apply, but they're also the most in tune with the market action. Many variations are available. Here are 3 of particular interest. Okay, number 1, parabolic stop and reversal model. Invented by Wallace Wilder, the parabolic concept is easy to illustrate and hard to describe. The principle is to create an indicator that rises by a factor of the average true range as new highs are being recorded, so that the indicator accelerates as ever higher highs are met and decelerates as less high highs come in. In an uptrend, the indicator is plotted just below the price line. It diverges from the price line in a hot rally and converges to the price line as the rally loses speed, as in figure 5-1. The parabolic stop is both self-adjusting and trailing, a rare combination. Figure 5-1. Okay, average true range stop. This is number 2. This stop is set just beyond the maximum normal range limits. I described the average true range channel in greater detail in chapter 14. With this stop, you take the average daily high-low range of the price bars adjusted for gaps and expand it by adding on a constant like 25% of the range. Say your average daily trading range is $3 and the price goes more than 25% beyond the $3 high-low range. You consider it an extreme price and the signal to exit. The average true range stop has the virtue of being self-adjusting, but it also has the drawback of setting a stop that has nothing to do with your entry. Number 3, Chandelier Exit. This stop solves the entry-level issue. Invented by Chuck LeBeau, the Chandelier Exit sets the stop at a level below the highest high or the highest close since your entry. You set the level as a function of the average true range. The logic is that you're willing to lose only one range worth, or 2 or 3, from the best price that occurred since you put on the trade. Like the parabolic stop, the chandelier is both self-adjusting and trailing. Indicator stops usually entail taking a loss greater than the turtle 2% benchmark rule. This factor hands you a hard decision. If you take the 2% rule, you have to live with the remorse of exiting trades only to see the price move your way later on. If you take an indicator rule that entails losses greater than 2% of capital, but have a series of losing trades early in your trading career, you could lose a lot of money before you figure out how to adapt your indicators. Time stops. Time stops acknowledge that money tied up in a trade that's going nowhere can be put to better use in a different trade or savings account. I don't know if they're trying to be funny with that. Say you're holding a position that starts going sideways. It's reasonable to exit the trade and find a different security that is moving. Remember, the purpose of trading is to make money. Clock and calendar stops. Clock and calendar stops pertain to a price event happening or not happening, considering the time of day, week, month, or year. Clock-based rules abound. Okay. Some technical traders advise against trading during the first hour in the US stock market because buy or sell on open orders are being executed then. Others say that more gain can be had from the first hour than any other hour of the trading day if you can figure out which way the crowd is trading. As I described in chapter 16, one setup technique is to buy or sell the direction of an opening gap and be done in an hour. In foreign exchange, you often see prices retrace at the end of the European trading day, about 11 a.m. in New York, because traders there close positions. Not only is this a swell entry place when you're sure that you know the trend, but it's also a benchmark for the US trading day. If the price falls to close higher or lower than the European close, it means that American traders are having second thoughts about the trend. Nice. All right, so when we come back, we'll read about adjusting positions, reducing positions, adding to positions, scaling in and out, applying stops to adjusted positions, managing your trades like a pro, and some other stuff. All right, thank you guys for joining. Remember that no matter what kind of market it is right now, there's no such thing as a bad trade, only bad entries. Remember your trading rules. If you are struggling during this current period, consider reducing the amount of money that you're trading with. Consider going back to paper trading if your losses have been too severe. And just remember that you need to document, and then you need to make adjustments as you continue on, as you progress as a trader, so that you can be improving your statistics of your own personal trading as opposed to staying stagnant or getting even worse over time. All right, I'll see you guys next time. Peace.